Hello ladies and gentlemen, I hope you're all doing well. Welcome to the channel. Today we're going to cover breaking news from the Federal Reserve and new data from Redfin. There's so much information to unpack here. Thank you so much for tuning in. One caveat, I'm a Florida, Georgia real estate broker, not a financial advisor. All right, let's begin. Okay, so here's the official FOMC statement issued May 4th, 2022. Although overall economic activity edged down in the first quarter, household spending and business fixed investment remained strong. Job gains have been robust in recent months, and unemployment rate has declined substantially. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. And it continues, the invasion of Ukraine by Russia is causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain. The invasion and related events are creating additional upward pressure on inflation and are likely to weigh on economic activity. In addition, COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. The committee is highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. With appropriate firming and stance of monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. In support of these goals, the committee decided to raise the target range for the federal funds rate to 0.75% to 1%, anticipates that ongoing increases in the target range will be appropriate. In addition, the committee decided to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities on June 1st, as described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in conjunction with this statement. It goes on to say, in assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures, inflation expectations, and financial and international developments. Okay, so Fed Chair Jerome Powell delivered dovish remarks following the FOMC meeting. The stock market initially rallied, and bond yields fell partially due to disclosing that 75 basis point hikes were not actively being pursued or considered by the committee. Powell also stated they would not sell mortgage-backed securities if they did not get enough Americans prepaying their mortgages and would instead roll off mortgage-backed securities. Powell did report that 50 basis point hikes would be on the table for the next couple of meetings, providing economic and financial conditions evolved in ways that are consistent with their expectations. Powell says there's evidence that core PCE inflation has either reached peak inflation or has flattened out. Furthermore, they do not foresee a wage price spiral or inflation expectations to be unanchored. The goal is to move to a neutral rate of 2 to 3%, which is an estimate with broad bands of uncertainty. This, however, would be a long-term estimate. The stock market reversed course, tumbling at the time of making this video. Consequently, the 10-year bond reached 3.09%, putting upward pressure on mortgage rates. Okay, so now we're going to go over some Redfin data. We're going to go over some leading and lagging indicators. Leading indicators will include pending sales, active listings, price drops, and days on market. Whereas lagging indicators include closed sales, since it takes time for houses to close, and interest rates were far lower in earlier parts of the first quarter. This is for the last 4 weeks ending on May 1st, 2022, and we'll start with the new listings. And as you can see, we're at 99,363 new listings. That's negative 5.7%. Pending sales were at 71,514, and year over year we were down 3.61%. There's also another indicator here. It's off market in 2 weeks, which means the house was on the market for 2 weeks and sold, and that was actually up 2.6%, and of total homes that sold within 56.5% of homes sold within 2 weeks. That's incredible. Okay, so homes sold, that would be considered a lagging indicator. And we can go there. That means there's 81,564 homes that sold. Year over year, that's down 5.8%. Okay, and then we're going to go to the new listing median price. And I apologize for this not opening as quickly as I'd like it to. Medium new listing prices were at 408,458. Year over year, that was up 16.47%, so that is huge. Median sales price That was what things actually sold for. The homes, that was at 396,000, and that's up 17%. And we're going to go to active listings. Active listings, you'll see that we have 534,610 homes. That's down 17.94% compared to 2021, which was 651,500 homes, and then going all the way back to 2019, which would have been active listings at 1,133,360. So this is a big, big drop. We really need inventory. Price drops. This was very interesting. You'll notice that price drops were up 3.7%, and that was 1.5% year over year. And month supply, we were at just about 7 weeks, and we're down about 0.7%. So yeah, guys, we definitely need inventory. Okay, one more bit of information for you would be the investor market share, which is at 18% for Q4 2021. And that varies market to market. One more thing, if you're considering buying a home in this market, I would suggest you pay close attention to investor activity. You want to buy in a market that is more market-driven opposed to investor-driven, since investor-driven markets are far more speculative. So in other words, investors have weak hands. Owner-occupied homes are more likely to weather the ebbs and flow of the economy, whereas an investor is more likely to sell during economic hard times, thereby driving prices down. If you'd like to know how saturated your market is with investors, feel free to post in the comment section and I'll send you that information. Okay, so what are the key takeaways here? The Federal Reserve Bank took a more dovish position than markets anticipated, leading to an initial rally. The federal funds rate was increased by 50 basis points, putting upward pressure on bonds and mortgage rates. The 10-year Treasury bond reached 3.09% at the making of this video, and the Dow Jones tumbled more than 1,200 points after initially rallying over 900 points the day before. Housing price drops have steadily increased. However, housing supply is still in great need. Home sales and pending home sales are also down. If you like this video, please consider subscribing to the channel and hit that like button. I'm a Florida, Georgia real estate broker, not a financial advisor. Thanks again, and we'll see you in the next video.